So here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car. Hey, Jason here. Today's investment analysis video, we're going to cover Simon Property Group, stock ticker SPG. Before I get to that though, I need to let you know you can get this series or this video as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and we release new videos all the time. Hey, welcome back after the long holiday Thanksgiving break. If you're in the U.S., I hope you enjoyed time with your friends and family if you could do that this year with the COVID stuff going on. Hope you had a good time. Hope you got some relaxation at the very least in this crazy year. Today's video, we're going to cover Simon Property Group. They own a bunch of malls. And I don't know if they own other properties, but I know specifically they own malls. They own malls all around the U.S. We're going to do a financial analysis, investment analysis of them. Before I get to that, though, I'm going to reference, I'm likely going to reference other videos we've done in this series. We've done videos on, for example, ExxonMobil, Cody, U.S. Steel, Archer Daniels Midland, Walgreens, CVS, and more. If I reference a certain video, it'll be in the links below this in the description. Also, I will likely reference some contents you can get for free, or you can get information for our courses. That'll be below this video in the description as well. And I have to put a disclaimer on here before we get to the main video, because I didn't on the first couple of videos and people didn't like that for some reason. This is for educational purposes only. I do not own stock in any of the stocks I talk positively about. I do not short sell. So I'm not invested either way in any of these stocks. Most of these stocks, or some of these stocks, are requested by viewers. So if you have a request of your own, I think we've done two so far. U.S. Steel was for Cody S, and Archer Daniels Midland was for Andrew W. If you want me to evaluate a stock for you anywhere in the world, I will do so. The only thing I will not evaluate for you is banks and insurance companies. Any other stock anywhere in the world, I'll evaluate. Let me know in the comments below. I think that's it. So let's get to the video. Let me bring up my screen here. Get this out of the way. Okay, so the only thing I've done here, again, if this is your first time watching one of these kinds of videos, the only thing I've done here is open up things. Most of the time, I don't even know what the company does. In this case, again, I know that Simon Property Group owns malls, frankly, because they have their signs up everywhere if you go to a mall, really anywhere in the U.S. Modified agreement there on a merger, likely modified due to the coronavirus. So that's interesting, not necessarily important right now for the initial stages of the analysis like we're doing here, but interesting nonetheless. First thing, if you've seen the other videos where I've talked about this, anything that has a dividend yield above 5%, give me some pause. Many times it's a red flag, not always, but when I see this, it makes me look, I always look carefully at the financials, but I look extra carefully if I see a dividend yield above 5%, because that typically means danger. Okay. Increase in sales as they've grown. Makes sense. Operating income, operating profit, frankly, are huge. I look for anything about 10% on a consistent basis. Theirs is between 44 and about 53%, 52%, rounded up. during this entire time period. And even in the last 12 months, in the trailing 12-month period, it's positive 46%, which actually is frankly surprising with the mall closures, mall tenants not being able to pay the bills, which I figured would have negatively affected Simon Property Group more because they actually own the buildings and the land, and they lease out the units, whatever they're called, in the industry parlance. I don't know what that specific term is. But they rent out the units to store owners like GNC. They're in malls, and they just filed bankruptcy earlier this year. JCPenney, same thing. So I'm surprised their operating profits are still as high as they are. That's frankly really surprising. Earnings per share. So we talked about this in a couple of videos. Their payout ratio is above their earnings per share, which is dangerous sign number one. This means that the company cannot fund its current dividend even after a significant dividend cut from $8.30 per share last year to $5.50 this year. I'm assuming this is due to the coronavirus stuff. Even with this large drop in its dividend, it's still only earned $4.40 per share. So this means it's paying out to shareholders more than it's taking in earnings. And it's unsustainable. Likely they funded this through increases in debt. Many companies have done that during the coronavirus stuff, or issuing shares, which we will see in a minute. They have issued some shares, but not to a large degree, and they haven't done any in the last year. So I'm assuming that their payout ratio being higher than their earnings, that they took on more debt to pay that and to pay operations, frankly, during the closures and lockdowns and all that kind of stuff. Book value per share falling over time, typically not a good thing. Typically you want to see this going up over time. Not necessarily a bad thing, but I'm guessing over the last couple of years it looks like they might have had to write down assets, because at its high point they had just under $19 per share in book value per share in 2012. Now they have $5.21 per share. I'm assuming this is due to write-downs and or asset sales. Again, not necessarily, well, the write-downs aren't good. And I talk about that, I think, in the Cody video and the ExxonMobil video. If it was due to asset sales, that's not necessarily a bad thing. Again, I'm assuming, well, even just in the last year, it's gone from $8.57 per share to $5.21 per share. That leads me to thinking that it's an impairment thing, which we will find out in a little bit. And free cash flow is good, but I'm assuming a large chunk of this being positive is due to the issuance of debt. ROIC, again, I've talked about this in several videos. ROIC, super important to me. 7.5%. I look for anything above 10% on a consistent basis. Simon Property Group has been just under that most of the time. The big thing here, though, is the ROIC at 7.5% compared to the ROE of 62%. That shows me that the company has an enormous amount of debt, because ROE is levered by debt, while ROIC is not. And the higher the ROE is compared to the ROIC means the more debt the company has. So in this case, I can already tell that SPG has likely a ton of debt. Free cash flow to sales, again, fantastic, but I'm assuming also due to issuances of debt. Cash levels are surprisingly low. I figured, because I can almost guarantee, yep, their debt's risen significantly just in the last year from 74% rounded up to 80.1% in the trailing 12-month period. Frankly, I'm a little bit surprised that their cash levels have only risen from 2.1% to 3.4% of the balance sheet in the trailing 12-month period. I figured that would have been higher, but maybe they're burning through a ton of cash, frankly, faster than they because things are closed, and frankly, people aren't going to the malls as much either, even with things open. And now that things are closing again, that's an issue. Cash conversion cycle doesn't matter here. So let's go to the financials. Not great here. Again, I've talked about interest coverage ratio in a couple videos. I'll just do a quick recap of that here. Interest coverage ratio essentially shows how much or how well a company covers its interest payments on its debt with its current earnings. Typically, you want this to be higher, as high as possible. Anything above 1 shows that the company can cover its current interest payments on its debt with earnings. But this being at 3 is not a huge amount above 1, and its debt to equity ratio is 15. I look for anything below 1 typically, kind of as a general rule of thumb. So again, going back to the debt issue, which we'll talk about more here shortly. I'm assuming they have a ton of debt based on their numbers so far and this debt to equity ratio. So let's find out by scrolling down. $25.6 billion in debt, rounded up, compared to $27.1 billion market cap, which means after subtracting debt from net debt, even they only have $1 billion in cash compared to $25.67 billion in debt. When you subtract total debt from cash, it almost equals market cap, which is not a good thing. And I can guarantee as well, because the other stuff we talked about, that its assets are likely overinflated, and that has likely led to impairments in recent years, which we will talk about when we get to the cash flow statement. For now, let's stick here. Actually, we're going to talk about impairments here possibly as well. Cash. Their cash levels vastly, significantly fallen from last year. That's not good. This time last year, they had about $3.7 billion in cash. Now they have 1.1, even after issuing more debt, which means they're burning through a ton of cash, while tenants aren't able to pay their bills due to lower client volumes or closures or quarantines or lower traffic volume or half capacity or whatever is going on in your locality. Frankly, none of that's good. Amortization. We'll not talk about impairments here because they don't have any showing up on the balance sheet. So we will look. They don't even have any goodwill or intangible assets anymore. So we're going to look at that on the cash flow statement going back a couple of years. We already talked about their huge amount of debt. Not good. Okay, so their balance sheet doesn't look horrible like I expected. Frankly, with their large amount of debt, frankly, I expected it to be worse looking. I expected there to be goodwills and intangibles on here in significant numbers that would likely have to be written down, but they are apparently already gone. Again, we'll find out if that was due to impairments and write-downs in the past when we look at the sheet here, or at the cash flow statement here in a little bit. But frankly, their balance sheet is not good due to their huge debt, but it's not as bad as I expected, frankly. And this, I don't remember which video we talked about retained earnings and accumulated deficit in, but I've talked about it before. And this measures the entire profits or unprofitability the company has earned over the entire life of the company. So in this case, because it's negative, it's called an accumulated deficit. And in this case, Simon Property Group has earned a negative almost $6 billion in net profits in the history of the company. Typically, this is a terrible thing. Accumulated deficit, especially that big of one, is a terrible thing because this, while it's not really necessarily a quote unquote real economic number, it's still a drag on the company's value. Because if the company were to sell, for example, let's say it were to sell today, it would probably sell for $6 billion less just based on the balance sheet because of its long-term unprofitability. The opposite is also true. If this was, let's say, positive $6 billion over time, it would be a positive for the company and would increase the value of the company. Again, it's not necessarily a real economic number until, let's say, they sell the company, the entire company. But in that case, it's a big deal. Okay, let's go to cash flow statement. Let's go to yearly. Oops. Okay, so I'm going to search here. Impairment. So they don't have any impairments. That's a little bit surprising. So let's go through here and see if we see anything odd in the cash flow statement from year to year. Nothing super odd down here, but frankly, most of the odd things happen down at the bottom part of the cash flow statement anyways. Okay, so here we go. Especially during this time with the COVID stuff, a lot of companies, this section, issuances of or repayments for long-term debt, has a lot of stuff going on here. And SPG looks like they regularly every year issue a lot of debt and then repay that debt. So they kind of do what's called a debt ladder, or debt stack, whatever you want to call it. And they issue debt to fund operations, acquisitions, growth, CapEx, all that kind of stuff. And then they pay off that debt, hopefully at a lower interest rate. And they keep doing the same thing over and over again. In this case, they're negative, was about $2 billion over the last 5 years, which is frankly not that much, which means they've added a net total of $2 billion positive to their balance sheet in the last 5 years, which is, again, frankly, not as bad as I expected. It's not good, but it's not necessarily as bad as I expected either. I have a preferred stock, which is interesting. Most modern companies don't have preferred stock. And if they do, it's typically not a good thing. It either means they IPO'd and they're paying kind of preferential rights to shareholders. In this case, though, I would guess they're kind of treating this like a preferred stock, like a debt instrument. So they're issuing preferred stock, paying a dividend on that, and treating it kind of like a like debt, but not classifying it as debt. That would be my guess here. Again, not necessarily a horrible thing, but it's not necessarily a good thing either. Unless you get the preferred stock at a decent price, that is. Oh, so I said they're losing a lot of cash. They've lost about $2.6 billion in cash in the last year. Ooh, that's not good. Net total, actually. So after all positives, after all negatives, the net number is negative $2.6 billion in the last 12 months. That is not good, especially when you're already having to take on more debt. Okay, valuation. Okay, PE, price to cash flow, forward PE. I don't, again, if you watch other videos, I don't really care about these too much, but it is one sign that the company could be overvalued or undervalued. In this case, for these three on kind of average, SPG looks about fairly valued. I'll look for anything under 20 on these metrics, but the more important one down here is enterprise value to EBIT. This is enterprise value to operating income or operating profits. And I look for anything below 8 on this metric, and it's 22.6. So this shows when you include the debt and the cash of the company, which is why I prefer enterprise value over PE or market cap, is because 99% of the companies in the world have debt and cash. So when you include those as a total business owner, or when you think about those as a total business owner, and that's how I look at stocks or any investment, is I want what would I want to pay if I were the total business owner? What would I pay for, frankly? The assets and the liabilities. I want to know about both. And in this case, compared with profitability, SPG is way overvalued. So combined with their debt load and the coronavirus stuff, which again, I'm frankly shocked Their operating profits are still high. I know why their cash flow is still high is because they're issuing debt. I'm frankly shocked that their operating profits are still high. But with the coronavirus stuff and new lockdowns happening, combined with the overvaluation, debt load, stuff like that, frankly, there's no way. I look at this company right now, maybe after this turnaround is over, or the virus and stuff go away, but frankly, they still have way too much debt for me. So, in my opinion, stay away from Simon Property Group. If you own its stock already, I wouldn't own it. If you're thinking about buying its stock, frankly, I wouldn't recommend doing that either. So I would recommend it just completely straight avoiding SPG stock for the reasons mentioned. And I hope you learned from this. I hope you got some value of it. I hope you liked it. Apparently, it seems like a lot of people like these videos. I'm getting a ton more videos, ton more subscribes. So if you want more of these kind of videos, let me know in the comments below. If you want me to evaluate a certain stock, let me know in the comments below. If you're listening on YouTube, make sure to like, love, share, subscribe, all that good stuff. And hit the notification bell so you're notified every time I release a new video, and release new videos all the time. If you're listening on the podcast, again, like, love, share, subscribe, all that good stuff. Really appreciate it. And we really also appreciate a review, because the more reviews, views, listens we get on our content, the more people we can help. And speaking of help, if you're looking for free resources on how to become a better investor faster, you can get our 5 free gifts, including my valuation templates below, for free. You can get a PDF copy of my book, How to Value Invest, for free. You can also get our guide, 3 tips to picking great stocks, and or 7 tips to picking great stocks and 3 times you must sell. All those for free all those below are for free. And if you're looking for more information faster, you can also get information on our masterclass at the links below as well. But until next time, have a great day. Talk soon. Bye.